Socially responsible investing. Socially responsible investing, or SRI, is choosing to invest in stocks that provide financial gain as well as do social good. Here, we choose to invest in companies that are not only financially stable but also make a positive impact on the environment and society. In many countries, industries such as tobacco and liquor are referred to as sin industries and are avoided to invest. In SRI, the companies are generally evaluated based on the ESG index: environment, social justice, and corporate governance. Although socially responsible investing is still up and coming in India, it is expected to gain greater momentum in the next few years. Companies have become more aware of the ESG factors and are looking to incorporate more of it in their business practices. Sustainability indexes. If you look into the American and European nations, they already have a family of indices evaluating the sustainability performance of thousands of companies trading publicly. The Dow Jones Sustainability Indices, also referred to as DJSI, launched in 1999, are the longest running global sustainability benchmarks worldwide. To be incorporated in the DJSI, companies are assessed and selected based on their long-term economic, social, and environmental asset management plans. For India, S&P BSE has three main indices that measure corporate sustainability. First, S&P BSE 100 ESG Index. Second, S&P BSE GreenX. And third, S&P BSE CarbonX. How to be a socially responsible investor. Here are a few points that can help you become a socially responsible investor. First, know the difference. The first and foremost important step to becoming a socially responsible investor is to know the difference between traditional and responsible investing. The difference might be in returns that you get from your investments. The returns from socially responsible investing may differ a little from traditional one, as you might be leaving behind a lot of high return investment options. However, always remember the reason why you have opted for this way of investing. Second, do your research. This is where investors use negative and positive screening to shortlist investment options. In the negative screening, they avoid investing in companies that don't relate to their social values. Many mutual funds that are socially responsible screen out tobacco and liquor companies. One type of negative screening is divestment. This is where investors take their money out of certain companies because they do not like their business practices or social values. Along with screening out negative companies, it is also important for investors to choose companies that align with their values. These are the companies that strive to bring change to a social aspect that the investor finds important along with their socially responsible business practices. This is also known as impact investing or incorporation of ESG. Third, use your influence as shareholder. Shareholders not only invest in companies that align with their values, but they also use their position to influence the actions of the company in which they own stock. Investors do this by filing a shareholder resolution. This is a document outlining the shareholder suggestions for management on how to run the company in a more socially responsible way. Fourth, invest in the community. This is where an investor invests in companies that have a positive impact on the community. This is usually done in low-income areas where the investment is used to provide loans to people and small business owners who would otherwise have trouble getting approved for a loan. Community investments also support green companies that have a small carbon footprint on the environment. Fifth, lead by examples. Socially responsible investing is still in the early adoption phase. By making the right investment choices, you can make a real impact on the community, along with building wealth. Moreover, sooner or later, social consciousness will become the selling point for global companies, and you, being a part of it, can lead the movement. Conclusion. Socially responsible investing is becoming increasingly popular in India, and there has been a visible shift in the market strategy adopted by many participants as they incorporate social, economic, and governance factors into their investment process. Stakeholders realize the importance of their role in financial markets to influence sustainable growth. Social investing in India has helped provide basic needs such as housing and education to the poor. Many investors have now realized the power and influence they have to make a positive impact on society.